and welcome back to our Insider Interview series. I'm Dave Baxter, Senior Fund Content Specialist here at II, and today I'm joined by Ian Mortimer, Co-Manager of the Guinness Global Innovators Fund. Ian, thanks very much for joining me.
Pleasure, thanks for having me.
So Ian, innovation can be quite a subjective term. People interpret it pretty differently. So first of all, tell me, what does the fund do? What kind of companies do you look to buy?
Yeah, you're right. So we've been running this strategy as a firm for over 20 years. And I think the word innovation can mean different things for different people. I think the best way to think about how we run money and what we're looking for, though, is really good growth companies. We're looking for companies that are exposed to secular growth themes and within themselves may be innovative, but ultimately really good businesses that can compound and grow over time. So we're not looking for the next big thing, very early stage companies, all that kind of speculative end of the market. So I think for us, innovation really comes through in terms of that kind of compounding idea and doing interesting things. But as we can talk about, there's lots of other characteristics that we're looking for, because ultimately it's also thinking about what makes a good investment. A company might be super interesting and doing something very exciting, but is that actually a good investment? And I think that's a kind of a core concept that we want to kind of think about.
So what kind of metrics are you applying to make sure that you're not just buying some kind of speculative, unprofitable bet?
Yeah, so really, if you think about where we're starting it's sort of, the idea is, if you can find companies that are growing faster than the market, they can outperform. Now, that's a very simple premise, but it's quite difficult to achieve. And one of the hard things to sort of think about is there isn't really any sort of quantitative measure that you can screen for that will tell you a lot about whether that company will grow faster than the market in the future. A lot of people look at things like historic growth, but actually that really doesn't correlate very strongly with future growth. It's pretty uncertain. So instead, we have to sort of take a slightly more subjective starting point. So we look for a range of sort of secular growth themes. So we've got about 9 that we typically look at. These look at a variety of different sort of ideas. We then find companies that are exposed to those secular growth themes. So hopefully they have a good potential pathway for growth. And then to a point on whether they're a good business, we then apply what we describe as a quality cutoff. So we look for things like companies that have a return on capital above the cost of capital, companies with strong balance sheets, companies that actually have earnings. So we're not looking at that sort of early stage, what does the business model look like? And from that group, we're then doing bottom-up stock selection. So we are applying a valuation discipline because we think value is important in the context of growth.
One accusation that gets leveled at kind of innovation funds is that they're simply tech funds. So how would you defend yourself against that?
Yeah, I mean, I think we have heard that before. And I think, that tech is clearly an area that fits a lot of the criteria we just described. There's a lot of really good businesses that have good, strong pathways for growth. But I would say 2 things. The first thing really is that although we have had a high weighting towards tech historically, it generally has been around 40–45% of the portfolio. Within that, there's different types of industries within the IT sector. So there's semiconductors, there's tech and hardware, and then there's also software businesses. And each of those have a slightly different sort of business model. The second thing, though, is clearly over half our portfolio is not in the IT space. We've got good exposures to areas such as industrials, financials, consumer discretionary, for example. And I think the pushback I'd have is that slightly broader set that we're looking at, although it might be tech biased, definitely gives us a different exposure and I think different potential outcomes to a pure tech fund. And I think if you compare our portfolio to a pure tech fund, it will have slightly different performance and it will potentially have different performance in different market environments, which again I think it makes it somewhat attractive relative to that tech.
And beyond things like tech, beyond things like AI, what secular growth themes are you investing in?
Yeah, so I think in terms of that sort of starting point, it's fairly broad. So we're not saying we are going to be better than the next person at finding the next big thing, because as we just described, that's really difficult to do on a consistent basis. So yes, within our themes we're looking at, we do, as you rightly say, have things like AI, cloud computing, and so forth. Tangential to that would be things like robotics, for example. But also we have things like advanced healthcare, more areas like the kind of consumer-orientated type businesses within that as well. And I think, by having that slightly broader thematic approach, I think one of the things we're avoiding is that idea you kind of get these bubbles. Or people get it's kind of the hype cycle, I think Gartner described it as. Yeah. And we've seen that time and time again over the years we've been running the strategy. It'd be things like biotech, or it could be 3D printing, for example. And people tend to get very excited, gets a bit hyped up, and then maybe the reality doesn't match that hype, and then you suffer potentially the drawdown, which is often a de-rating as opposed to necessarily the company's doing really terribly. So by having that kind of multi-thematic approach and being slightly broader in our opportunity set, we then hope we can find good businesses exposed to good growth areas. And really it's the valuation part that's driving a lot of where our allocations are going from. We're not trying to fill buckets. We're not saying, this is a good theme, we should have 10% in that, that's a good theme, 10% in this. It could be, if all robotics companies are extremely expensive, there would be none of those in our portfolio, because that doesn't make a good investment.
These themes, things like AI, can come with a lot of hype, they can come with a lot of froth. How do you navigate that when you're investing in these companies?
Yeah, I think the first thing is the kind of a way of thinking about it is a little bit of kind of extremes, so kind of probability distribution. We're not looking at the extreme tails. So if you think about the very, things like in the pandemic when we had, Peloton as the extreme example, huge rally, it did not reflect at all ultimately what that company could achieve going forward. Valuations were very, very stretched. We're clearly avoiding those. As you then come more towards the middle, I guess what we're trying to do is balance that idea of, we want to let our winners run. We want to have companies where that pathway for growth is relatively long, and we want to keep sort of supporting those companies and benefiting from that growth. However, there's clearly a limit to that. So, we are valuation disciplined, and I think the first thing we're doing is we run a portfolio of 30 positions, and they're approximately equally weighted. So all of our positions start live for about 3.3%, and we're happy for them to run up. But if we start getting sort of towards 5% or above, we may step in and kind of reduce that weight down. So kind of within the mechanism of the portfolio construction, we're actively taking profit if companies rally too far, and that's often associated with an increase in valuation. Not always, things, you mentioned some of the Mag 7 stocks, things like Nvidia. As that's rallied, actually, the valuation of that's come down because the earnings growth has outpaced some of that price growth, and therefore the valuation has compressed. So we're taking all of that into consideration, and ultimately part of our sell discipline would be if we felt the valuation had got too rich, we would potentially sell that company. And I think a good way to think about valuation in the sense of growth investing is a little bit like kind of more not necessarily the absolute valuation, but also kind of what are you paying today for the expected future growth. So if you think about a sort of a simple analysis of a company, if you can understand the current cash flows, and you imagine they're just flat, so just maintenance capex, so they're just reinvesting to kind of keep going. If you discount that back, you could get an approximate valuation for those cash flows. If you compare that to the current market cap, the difference is what you're paying today for the future growth.
Yes.
So, and how expensive is that option? Because what we know is, as we mentioned at the beginning, future growth is very difficult to predict. The market isn't brilliant at it. It's very hard to do quantitatively. So therefore, if you're paying a big price for that option today, it could easily disappoint, and that's where you tend to get those valuation pullbacks or the deratings of these kind of growth companies. They're not that they necessarily have to do terribly, they just have to not meet the high expectations. Yeah, and so therefore it's the rate of change type argument. So a lot of the work we're doing is thinking about what are we paying today for the future growth and how expensive is that option? Because what we'd ideally love to find is companies where you've got a great business today, you can understand it, maybe the market isn't necessarily pricing that future growth very highly. If it doesn't come through, you should hopefully limit some of your downside. But if it does come through, you can potentially get the strong benefits of that re-rating story and that growth coming through. And I think one of the things we talked about before with clients is if you're not going for those big winners, are you going to be missing out? And I think there's some interesting research that we've seen, and it was looking at 10 baggers in the US equity market. So kind of stocks where the price performance had gone up 10 times, and they analysed it back. And you look at, of all those types of examples over the last, I think it was about 50 years they looked at in the US equity market, what do those companies look like at the beginning of that journey? And you generally found there were slightly larger companies, so market caps tend to be sort of $5 billion plus. The companies tend to have earnings, and the multiple tend to be about the same as the market. So you weren't paying these big premiums. Why did those companies go up 10 times? The revenue grew faster than the market expected, margins expanded alongside, therefore the earnings compounded up faster, and then you had the re-rating story on top. So one of the things we would say is, we think you can apply that valuation discipline. You don't have to stretch for those extremes. We think that gives you a better chance of a good return on average, but it doesn't preclude you, by the way, from owning some companies that do extremely well. And we've had plenty of examples of that through the life of the fund. Things like Netflix went up 10 times in 2007. We've owned Nvidia for more than 20 years in the strategy. More recently, it's things like LAM Research or KLA, Applied Materials and the semiconductor equipment manufacturers. These are all types of those sorts of examples where actually, at the starting point, they weren't really richly valued. They weren't at these extremes, but they actually came through and did extremely well.
And on the theme of innovation, what are some of the big, I suppose, kind of risks people should be aware of? I mean, one I think of is perhaps it's more sensitive to interest rates. The fund, like many others, did take a bit of a clobbering back in 2022. Yeah,
and I think that's more the style, I guess, of growth, right? So, and I think the example you're seeing there is there's quite a big difference in terms of what shifted in the narrative in the market. So if you think about kind of post-financial crisis up to the pandemic, we had a kind of zero interest rate environment. And it was a really good time to be sort of investing in growth. And you saw, a lot of kind of funds or stocks that did well were those higher growth the better, right? They were really rallying a lot. Whereas as you rightly say, that started to change. First, you had this kind of speculative sell-off post-pandemic in 2021, and then in 22, you had the interest rate regime change. I would say, if you think about that spectrum of growth investing again, if you're at the more extreme end with the very, very high valuations, a lot of the future value, a lot of the value today is in the future. That's what you might argue is kind of a higher duration kind of growth investment strategy. And I think that was more affected. I think we're on that spectrum, and we recognise that. We have quite a clear focus on the types of companies we're going to be investing, the kind of factors we're exposed to, but I think it was less extreme. And I think if you sort of look at our track record, maybe compared to sort of different types of growth investing, I think actually, we did very well leading up to the pandemic, but we didn't capture all of that upside in those kind of that frothy type market. But I think we did better, particularly in the speculative sell-off in 21. And I think we were maybe relatively less affected by some of those changes that maybe we had seen. Yet we've still kept up very well with things like Mag 7 and the AI story. And what are a couple of lesser known stocks currently in the fund? Yeah, so I think, thinking about maybe things outside of tech, I think we own a company called Anta Sports, for example. So that's in the consumer discretionary space. So it's a bit kind of like, you could think of it like the Chinese Nike or the Chinese Adidas, for example. So this is a company that's making apparel and footwear. It's actually a kind of a multi-brand product, and it's done really well out of bringing in Western brands like Fila into China and then selling it domestically. It's done quite well making acquisitions like Amer Sports. More recently, it's taken a stake in Puma, for example. And if you look at sort of the financial characteristics, it's got better gross margins. They manage their business to be more profitable than maybe some of those Western brands. And I think that's a good example of a company that might not necessarily be associated from that growth perspective, but is in a very different area to something like tech, but has a lot of the things we would like to see, whether it's barriers to entry or sustainable competitive advantages versus their peers, and also that pathway for growth. And I think they're doing that in multiple different ways, whether that's direct to consumer, whether that's through building out, selling to more children's wear, for example, whether that's building out Western brands into China. And I think that's definitely a stock that I think would be different to maybe some of those sort of typical tech type stocks that you might expect to see in a growth portfolio. Ian, many thanks for your time. Thank you.
And thank you for watching. Do let us know, as always, what you think in the comments. And if you're a fan of this series, hit the like button and hit the subscribe button. Thanks and take care.